Hi guys, I am the commerce specialist. In today's video, we are going to talk about a very important concept in finance. At the same time, it's very simple as well. So if you're pursuing any academic qualification or professional certification, definitely you will come across this concept. We call it bond valuation. Now, before we go to the valuation part, you need to understand what is a bond. Basically, a bond is a loan certificate. Organizations, when they are in need of money, especially public limited companies, they normally have two broad options. Either they sell their own shares, but if they don't want to sell shares, they can go for selling their bonds. So bond is a loan certificate. When a company sells bond, the company gets money, and the person who has purchased the bond becomes the holder of the bond, or we call it investor. Now obviously company sold the bond because company needs money. The person who purchased the bond is also looking for some returns. And let me tell you, bonds are normally long-term liabilities. So what I have done here is I have just drawn a bond here to make you understand what are some important terms which you need to know before we go on valuation of bond. The very first thing you need to be familiar with is the face value. Face value is also known as nominal value or par value. And what is it? Just like a currency note, like if you have a $20 note or $100 note, it's 100 written on it. That's the face value. So bonds also have face value, and here it is $1,000. Generally, the face value is given to you in the question, whether it is $1,000 or $100, whatever. Another thing you need to know is the coupon interest rate. As I told you, those who invest in bond, those who purchase bonds of the company, they're looking for some returns. This is the return promised by the company. Those who buy our bond, we pay them interest, which is known as coupon interest, 8%. And till when it will be paid? It will be paid till the maturity period. The bond is for 5 years. So today you buy the bond, you give us $1,000, we give you the bond certificate, and till 5 years, we keep paying you 8% interest every year. At the end of the fifth year, we will pay you your money, original money, which is 1,000 back, and we will take the bond certificate. This process is known as redemption of bond. Now, please remember, when we're selling the bond, this is what we are promising. But you as an investor, you have all the options available. You can invest in something else in the market, or maybe similar bonds of other companies. So we also need to know what is the market rate of interest on similar instruments. So for example purposes, I have assumed that the market rate of interest is 10%. So now what's going to happen? The market offers an interest rate of 10% if you invest somewhere else, but you invest in my bond, in my company's bond, we will pay you 8%. So now you'll be thinking, this company, which is my company, is offering a lower rate. So if it's a lower rate, then how much you should purchase the bond for? Should you pay 1,000, more than this or less than this? For this purpose, we calculate value of bond. In other words, we call it present value of bond, which means if you're buying the bond today, how much you should pay? There are many possibilities. Maybe a 1,000 bond, which has a face value of 1,000, is sold for 1,000. Maybe it is sold for a little higher or maybe less amount. So that's what we are going to do. We are going to find the value of bond. Now, if you need to calculate value of bond, there are just two steps. First thing is you need to look at the interest payments. You are getting interest 8% per year, every year for 5 years. So always remember, this coupon interest is calculated on the face value of bond. So if I check how much interest it comes to, it is interest rate is 8% on $1,000. So this comes to $80. This means 80 per year for 5 years. Now, whenever we're trying to calculate present value of the bond, as I said, there are two steps. Step one because we are getting this interest every year for another 5 years, these are in future, we need to know what is the present value of these interest payments. In other words, time value of money is involved. Time value of money means, for example, if you have $100 today with you and this $100 you are going to deposit in a bank which gives you 10% interest. So after 1 year, this $100 will become 110, which means today the value of $100 is $100, but after 1 year it will be 110. So if it is 110 after 1 year, today it is how much? Less than 110, which is $100. Likewise, we need to see that this $80 which we are getting in 5 successive years, what is the total value of all these interest payments which we are going to receive in future, how much they are worth today. So what we do is, in order to calculate the present value of this $80, what we do is we multiply this $80 by present value interest factor of annuity, where we take n as 5 and the discount rate to find present value, we always use the market discount rate, okay, which is 10%. Now I use the word here present value interest factor of annuity. So annuity needs a little explanation here. So annuity is a fixed amount paid or received for a fixed number of years. So the definition fits here. We are getting a fixed amount of $80 every year for 5 years. So the $80 is a fixed amount. We are getting it every year, not forever, but for 5 years. So that's why I'm going to use the annuity table. Now, if I take this $80 and multiply by present value interest factor of annuity, the annuity table looks like this. Here you have n, and for us n is 5, and here you have percentages, let's say 10%. You may have 1%, you may have 8%, 10%. So you look under n5, under 10%, you will have a value, okay, that is around 3.791. So this $80, when you multiply by the present value interest factor of annuity, you will get something like $303. So in other words, this $80 which you are going to get in another 5 years, means $80 every year for another 5 years, what is their worth today? Their worth today is $303. Another thing you need to know is that for any bond, the issuing company, the company who's selling the bond, is promising you that after 5 years you will get this 1,000 back. Today which you're paying, you will get it back after 5 years, which means again future. So if I'm going to get 1,000 after 5 years, what is the value today? So in that case, what I'm going to do is I'm going to take the face value and I'm going to multiply it by present value interest factor, not annuity, just interest factor. Why? Because I'm not getting 1,000 every year for 5 years. I'm just getting 1,000 after 5 years. So this will again be n is 5 and we are talking about at 10%. So this 1,000, again this table was for annuity, which will be written like this, present value interest factor of annuity. But now you look at another table which is just present value interest factor. Normal present value of $1 it will give you. So if I check the table, likewise I will look for 5 years and under 10%, but if I'm looking at just present value, not the annuity, the value is coming to 0.621. So if I multiply this by the present value interest factor under n number of periods for 10%, it's coming to 0.621. So when I multiply 1,000 by the present value interest factor, I'll get the present value of this 1,000 which I'm going to get after 5 years. I need to know how much is it worth today. So it's worth today 621. So now when you add the present value of all interest payments or receipts, if you are an investor, you are calculating it as receipts. For a company, it's payments. And the present value of face value, after 5 years. So when you add the two, how much you're getting? 924. Oh, it's dollars. So this is the present value, or you can call it market value of bond. In other words, if you are a person who's interested to buy a bond like this, where the company says the face value of bond, which is 1,000, we will give you 8% interest on 1,000 for another 5 years, and after 5 years you will get $1,000, and during the 5 years you keep getting 8% interest, which is $80. So for a bond like this, how much you should pay today? Now one thing is very important here, which requires a lot of attention. If you look at the interest the company is promising you is 8%. But yes, you had a choice. You could have gone invested somewhere else. So outside the interest rate, the going interest rate is 10%. But if you still buy this bond, because the bond offers interest which is less than the market rate, the present value of bond is just 924. So for a bond which is 1,000, actually you are just paying 924. Why you're paying 924? Because it offers less interest as compared to the market interest. Students always ask me, like, if annuity tables are not there, so how do we get these values? So the answer is simple. If you want to find present value interest factor of annuity for 5 years and at 10%, for annuity the formula is like this: 1 minus 1 plus r to the power minus n, whole thing divided by r. So both the ones are by default in the formula. R, if you look at 10%, R actually is 0.1. Here again it is 0.1. Minus n, this is 5, so it is to the power minus 5. So when you insert the values here, it looks like this: 1 minus 1.1 to the power minus 5, whole thing divided by 0.1. If you do this, you will directly get 3.791. Students also ask me, if it's not annuity, it's just normal present value, which means this one. How I got this? What you do is simple. You divide 1 by 1 plus r to the power n, not minus n, just n. So if you do that, it is 1 divided by 1.1 power 5. And when you solve this, you get 0.621. So decision is yours. You want to use the tables, quick and easy. But the only drawback for tables is table does not provide you all the values, which means table may give you values for 1%, 2%, 5%, 10%, but not for 11.5%. So if that is the case, you have to calculate it yourself. One more example I need to explain you here. What if the market rate is less? Then what happens? Does this holds true that if the market rate is less, the value of the bond should be high? Let's have a look. So guys, now we are finding the value of the same bond, everything else the same, but I'm just changing the market interest rate to 6%. Which means if you buy the bond of my company, if you invest in my company, if you lend my company, I'm going to pay you 8% every year on 1,000 for another 5 years. Whereas if you invest somewhere else in the market, they're just going to give you 6%. If that is the case, don't you think the market value of my bond should be more than what it is stated on the face of it? Obviously, I'm offering you more than market return. Market is giving you 6, I'm giving you 8%. In other words, I'm trying to tell you, if you want to buy the bond today, you got to pay a higher price. How much? Even you can calculate it and I can calculate that. I means the company and you means the buyer. So basics remains the same. If we want to calculate present value or market value of the bond, you need to do two calculations. Number one, calculate present value of all the future interest payments and present value of the face value. So interest payment remains same because 8% of 1000 is 80. So this remains the same. So what you're going to do is, first step, you're going to calculate present value of all interest payments or receipts. Okay, so $80 I'm going to multiply by present value interest factor of annuity, and 5 years, which is known as N. So I'm going to look under N5, and always when you're talking about present value, you have to discount it with the market rate. So under 6%. If I do this, I get 80 multiplied by, again you can look for this value in the annuity table or go like this, 1 minus 1 plus R to the power minus N, whole thing divided by R. If you do this, and if I just insert numbers in this, 1 is in the formula, again this 1 is in the formula, interest rate now is 6%, which means 0.06, okay, whole thing to the power minus 5, whole thing divided by R, which is 0.06. If you do this, you are going to get a value as 4.212. And when you multiply, you get the present value of all interest payments. $80 you are getting every year for another 5 years, how much they are worth today. So when you multiply these two, you get 337 approximately. So half the question is done. We have found the present value of all the future interest which we are going to receive. The next step is to calculate present value of this face value. Present value of this $1,000 which you are going to get after 5 years. So if you're going to get 1,000 after 5 years, how much it is worth today? What you do is you multiply 1,000 by the present value interest factor, not annuity, just present value interest factor. Look under N equal 5 and 6%. So one way of doing this is, if you want to know this value without looking into the table, what you do is you just divide 1 by 1 plus R to the power 5. In other words, it is 1 divided by 1.06, because R is 6%, 6% is 0.06, 1.06, 1 the power just 5. If you do this, you will get an amount which is, this is the factor, 0.747. So when you multiply this 1000 by 0.747, this gives you 747. When you add, this is how much? 1084. So this is the present value of bond. So if you notice carefully, because we are promising you 8% interest and the market is just giving you 6%. So if you want to invest in my company which gives a higher rate, you got to pay a premium now. Premium means the bond's face value, apparently the bond value which is stated on the face of it is 1000. So a 1000 bond I am selling for 1084. Simple reason being because I am giving you higher in the market. The market is 6%, we are giving you 8%. I hope you have understood this. The only thing left here is, sometimes these bonds, they don't pay interest every year. The interest payment could be more frequent in a year. It could be quarterly, semi-annually. So if that is the case, how the calculation changes? Let's have a look. So if I keep everything the same and just change this amount, that it remains 8%, but it is semi-annually. Which means 8% is the annual interest, and this total 8% you will not get in one go, which means $80 in one go, but after every 6 months you get $40. So in this case, when I'm calculating the interest payment, see 8%, if it is annual, 8% of 1000 is 80. Okay, but now I'm not getting interest after 1 year, I'm getting after 6 months. So half of this, or in other words, you can make this 4% semi-annually. 8% annually or 4% semi-annually is the same. So what I'm going to do here is, if it is for year, it is 80 per year for 5 years. But now this will not be the same. In fact, this will be interest. 8% is for a year, but semi-annually, so 8% I divide by 2. So now it becomes 4%. 4% of 1,000 will give you $40. And you're getting $40 every 6 months. Now, if it is every 6 months, means in a year you're getting twice. So if the maturity period of bond is 5 years, so in 5 years, how often you are getting? In 1 year you're getting twice. So in 5 years you're getting 5 into 2. That means 10. Your N is how frequently you get the interest. So now you're getting interest 10 times during this 5 years. So now the steps are simple, just 2 steps. First, calculate present value of all the interest received. You're getting interest a total of 10 times, because 5 years is the maturity period of the bond. In 1 year you're getting interest twice. Why? Because it's semi-annually. So in 1 year twice, in 5 years 10 times. So N will now be not 5 but 10. Okay. And also look at this market interest rate. If it is 6 and we have semi-annually, so this 6 would be now 3%. So what we are going to do is, we are going to calculate present value of all interest payments. Okay, interest payment is 40. I'm going to multiply it by present value interest factor. Present value interest factor of annuity. And now N will not be 5 but it will be 10. And market rate is used to discount. I'm not using 6 because it's semi-annually, I'm making it half. 6 divided by 2 will be 3%. So if I do this, 40 multiplied by present value interest factor of annuity, N will be 10, under 3%. If I look at this, becomes 8.530. So 40 into 8.530 will give me $341 approx. Another step is to calculate present value of the par value, or in other words, present value of this 1,000 which I'm going to get after the term of the bond. So I'm going to multiply 1,000 by present value interest factor, just interest factor, not annuity. Again the N will be just 10 and 3%. So remember, I'm not looking for annuity, I'm just looking for just present value. N is 10 and 3% is the discount rate. If I do that, I get 0.744. So if I check this value in the table, it looks like this: 1,000 multiplied by 0.744. So when you multiply this, this becomes 744. You add them, this is 5, this is 8, this is 1085. So here again our logic holds true. What is the logic? The logic is, we are offering you 8%, but the market, other investments are offering you 6%. So if that is the case, if you are offering a higher coupon rate, then a bond which is for 1,000, you got to pay us, if you want it now, you got to pay us 1,085. Ladies and gentlemen, I hope you have understood this concept. If you have any questions or queries, please write it in your comments. I will definitely respond to you. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time.